Please, can you guys mute your camera? Can you guys off your camera and mute yourself?
No, no. Mute or off our camera. Congratulations, sir.
Christopher, off your camera. Good evening, everyone.
Good evening, sir.
Good evening. How was your day?
Good evening. Congratulations.
Congratulations.
Congratulations,
Good
sir.
evening.
No, this is not Yusuf Kabiru. I'm just using his handle.
This is not
This is
Kabiru.
Mr. Ibidu. This is Mr. Ibiduni.
This is to confuse me. It's to
This is
confuse
not
me.
Yusuf Kabiru. I've observed over time that you people think usually thought is the one. It's not though.
Receive the congratulations on his behalf.
Okay, I will convey it. No wahala. Okay, so this night we want to examine another standard, which whenever they bring it out, is one of those ones that students usually find tricky because it's a bit complex calculations that is involved. So generally, when it comes to standard, I can actually point out to very few number of them requires you to calculate extensively like that. So, but this is one of those that really need to understand the steps involved in the calculation that is involved. Otherwise, you may, because that's the area that we want to be, they be mostly interested to test over time. So I'm not sure I'm able to come up with the first question because I was trying to go through some other sources to simplify it. Once you understand it, yes, we can actually deal with the first question answer. But this night, I'm not able to come up with the first question to do. But this one too, there are two slides, two materials I'll be treating with you. So this is the first one. The second one too is actually addressing this issue of calculation and making it very simpler in a way that what you are seeing as content become a module. So that's what I'm trying to do tonight. So let's go right into it. Like I told you, you are dealing with IFRS 16. I hope IFRS 15 now, if you happen to meet questions in it in the exam hall, you'll be able to answer it correctly, and it's relatively easy now. So you need to also read and revise and review and before the exam for all the standards so far you have learned and the one you'll be learning too. So many preambles in this material. I shared a lot of materials with you. Please, if you have time, go through them at your leisure time. If you don't, try to see those ones that are not much. I know so many of them are following us, but that is the way, that's the full content, and most of them are sourced from the Big Four. So do well to benefit from them as much as you are capable, you are able. So, but make sure you understand standard. That one is the most important thing. So I am deliberately leaving out so many of the preambles, they don't concern us. So we're moving straight to what is a lease. I will read the definition, I will explain very well because I understand what it is all about. So, and then we'll go on now and I will break everything down. I hope we'll be able to grab it. So, lease definition, the standard does not change the definition of a lease, but makes changes to the guidance about how a lease is identified. So, why they made this statement is that lease is formally IAS 18. Are we together?
Yes.
Hello?
Yes, we are together.
So, lease was formerly IAS 18. So, they replaced it with IFRS 16. Majorly, because there are two types of leases. We have the finance lease.
What did that mean?
So the finance lease is likely going to lead to acquisition of that assets, while the operating lease is time ends within a year. So that's just the simple summary of what that is all about. So there was a controversy as far as who owns it, if it is finance lease at the lessees book or the lessors book, who actually is going to keep the financial records as per the update on the assets. So that was what led them to bring out IFRS 16 to correct that and harmonize. We get to understand that when we go through some of the materials and even in the course of our explanation. But they did not refer to all this I just told you. I'm just giving you background on that. So the contract, I'm dividing this now, is a contract or part of a contract that conveys the right to use. Please underline that. Right to use. That is the most important word that I don't know whether compound word that we can call it in this our discourse. Right to use an asset. To use.
Hello, sir. Your little attention.
Hello,
sir.
Yes.
The font character, can you increase? It's very
This thing
small.
now, if it show where I go to touch, or I don't know which I go touch, it just come like this.
Hello, sir.
Hold on.
The font character, can you be increased?
If I want to ask question.
It's very small.
How about now?
Thank you. Do it.
It's okay, it's better. Especially for those people for the YouTube end.
You said?
Especially for the people on the YouTube end, you find it very difficult to see it without.
Is it better now?
It's better.
Okay, so I'm going to tell you that when it comes to this, the most important set of words is the right to use an asset. And you should understand that word very well, because it's going to create two types of contracts. Part of that contract is a liability and the other one is an asset. So that right to use asset is an asset. There is another counterpart contract created, which created automatically through entries. You have a liability for the same asset, for the same item rather, or for the same property, and we also have an asset at the same time. So that's very, very important. The underlying assets for a period of time in exchange for consideration. Yes, in exchange for consideration. So meaning that you have the right to use the assets because you are paying for the usage. I hope you are on the same line. You are on the same hello.
We are with you, sir.
Yes, sir. We are with you, sir.
So it's actually conveys the right to usage of that asset because you are paid for it, for the usage. So what granted you the opportunity to make use of it, to take control. You know, we call it an asset, and the underlying important word is when you are defining asset is control. Remember your element of financial statements, 5 of them. So assets, when you are defining assets, you must measure control. If control is not there, then it's not an asset. So the right to use conveys the ability of the person that is taking charge to be able to take control of the usage, to use it as at when due. So this, I think in the second material, we'll be able to understand this very well. So definition of the underlying asset are set out in the standard now. An asset that is the subject of a lease, for which the right to use that asset has been provided by a lessor to a lessee. Who is a lessor? Who can help us? Who is a lessor?
The original of the assets. The one who is leasing it out to somebody.
Don't worry, yes, you are right. Who is a lessee?
The one paying the money.
The person that the right is
Person that wants to rent the asset.
So
The one who has the right to use.
person the asset is leased to.
The one paying the money to the
Okay, that's so paragraph 9 of the standard says that at the exception of the contract, an entity shall assess whether the contract is or contains a lease. This is very, very important.
Ahmed, please mute.
How?
Mr. Ahmed, can you mute and off your video, please?
I don't like that we are not interacting, but it's like you want to. You want me to shout?
Yes, people are muted and people are trying to show us themselves. I don't know why.
Sir, please mute everybody.
Don't worry. If you are removed reaction, I'll just ask you to. Thank you for coming. Who is able to talk there? So as I was saying, so before the contract commences, it must be examined whether it contains a lease. And there are 2 major points to confirm that we'll get there. So a contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time. You can see when it gives you the right to control the usage of an asset, of an identified asset for a period of time in exchange for consideration, that is in exchange for payments. That consideration is usually a legal time. So in exchange for payments, when you are paying in such a way that you now have the ability, the right rather, to control the usage of that asset, you can use it the way you want within the period you are paid for. A good example is a house that you rent. Within the time of your tenancy, you have the right to use it the way you want. subject to some limitations by the law anyway. So that is what we are talking about. It's the same thing. Lease and rent, they are synonymous. It's just that the way one is adopted is different from the other. So, but it's almost the same thing. So, or you need a particular machinery. You don't have the money to buy it. There are some companies that usually now rent it out for a period of time. The same thing. You can use that machine from morning till night, even 24/7, subject to some agreement you sign with the owner anyway. So, but within the ambit of your agreement, you can use it the way you want. So that is what we mean when we say that it conveys the right to control the use of an identified asset for a period of time, next for consideration. You are going to pay for it. It's not going to be for free. So, paragraph B9 to B31 set out guidance on the assessment of whether a contract is or contains a lease. So, you may want to take note of those paragraphs too. It will actually boost your marks in the exam if you're able to code them correctly. If you don't know them correctly, I beg, better don't code them out at all. Yeah. That would be disastrous. So the standard says in paragraph B9 that to assess whether a contract conveys the right to control the use of an identified asset for a period of time, an asset and an entity rather shall assess whether throughout the period of use, the customer has both of the following. You know, I mentioned there are two criteria for you to confirm whether it's a lease earlier on. Confirm you can hear me, just send an emoji. I want to be sure we're on the same page. Thank you. So the first one, please, is either, I don't know whether you are going to cram this one, whether you are going to memorize it, whether you are going to understand, just be able to bring it up when you are talking about this in the exam. Even if I used to tell you, when it comes to standard, even if the question do not require you to tell them what is the scope or what is the background on this, say your soul, you will not be penalized for doing that. In fact, you are going to earn some mark. They will realize that yes, you really know what you are doing. You understand the standard. So the first one, the right to obtain substantially all of the economic benefits from use of the identified assets. You can put it in another form, but it must mean the same thing. That is the right to obtain all the economic benefits from the usage of the identified assets. You can just, all what I've said now, I hope based on my explanation so far, you can understand it. And the second one, the right to direct the use of the identifier. One is to obtain all the economic benefits, all the benefits you can derive from that asset. Secondly, now that you have the right to control how that asset is used. So the definition of control is the same as set out in Ifrs 10. You know what Ifrs 10 is all about. That's part of the standard that set out your group accounts. So that's what we call the business combination. You have Ifrs 3, Ifrs 10. All of those are talking about the group account consolidation. So it is possible that under the new standard, leases which will have been operating leases, thank God I actually introduced you to IS. Oh, it's 17, sorry. I said 18 the other time. It's 17. So I introduced you to operating leases. So they are referencing it now. And I told you why they have to change it. So under IS 17 will be classified as contracts for services under the new standard and will therefore fall outside of the scope. You can get what I'm saying now. So because then it was confusing, it was not clear, there was no clarity as about okay, how do we term this one when it is not going to be for a long period of time, more than 1 year, 2, 4, 5, 10, 20 years. So how do we classify if it's just a short-term arrangement? So but Ifrs 18, IFRS 16 now came to clear the air on it. So going forward, it will be important to identify all contracts which include the use of an asset and review them at an early stage to determine whether or not they are lease contracts under both IAS 17 and IFRS 16. Don't worry about IAS 17 because it's no more applicable. It is expected that this will be one area where judgment will need to be applied and where accountants will need to be involved at an early stage to be able to assess the impact that the contract will have on the financial position of the organization throughout its operation. Accounting by leases. As already stated, all leases will be accounted for on the statement of financial position from the inception of the contract or the date that the standard is applied, whichever is earlier. Leases will be shown on the statement of financial position as an asset, which reflects the right to use the underlying lease asset and the lease liability, representing the obligation to make lease payments. Leases will be shown on the statement of financial position as an asset, which reflects the right to use the underlying lease asset and a lease liability, representing the obligation to make lease payments. So this is not confusing. I'm very sure me and you will agree that before now, we don't have such case that something will be standing as an asset and at the same time standing as a liability. So I'm very sure we don't have such. Do we? I want emoji. I'm not going to allow you to talk. I want emoji. Yes, it's okay. It's okay. So this is okay. The only possible exemptions to this are leases of less than 12 months duration and leases for underlying assets of low value, such as computers and tablets. The decision about whether to treat these exemptions as leases or not is for the entity applying the standard to make. In the all of this one, they are just terminologies referencing their own location. This job may be made by the HM Treasury or Department of Health, so I know it's not a peculiarity, it's not something, it's not a code that is general, so leave that. The lease liability will be the present value. Please, that is one. That's this what they are trying to explain now is very, very important to get to the practical way of applying it. So the lease liability will be the present value of the lease payment, not paid on the day the contract starts. This will be rate implicit in the lease, or if that is not known, the leases incremental borrowing rates. So they will give us. They don't worry about it. When we get to, like I said, I'm not sure this one contains any calculation, but the other one, we will get there. We go through the calculation, and the calculation and explanation is also there too. So you understand what we're talking about. So there will be liability and there will be assets. So they are not measured the same way, and they are not discussing in the same approach. So the incremental borrowing rate is the amount that the lessee would have had to pay to borrow over a similar term, an asset of similar value in a similar economic environment. So they will give you in the exam. This rate will therefore be specific to the lease being considered. That's why they have to give you. Past experience shows that it is unusual that the rate implicit in the lease is known. So this is another area where judgment will need to be applied to all lease arrangements. The right to use assets will be measured at the date that the contract starts as one, the amount of the initial measurement of the liability, plus any lease payments made on or before the commencement dates, less any lease incentives received, plus any direct cost incurred, and lastly, plus an estimate of any cost which will be incurred by the lessee at the end of the lease for dismantling and removing the assets. So these are the makeup of what the lease is all about. Okay, so a good example is here. A trust enters into a 10-year lease on 1 April. This payment of 50,000, I think this one is pounds, if I'm not mistaken. I'm not sure it's euro. Are payable each year at the start of the year. The direct costs incurred in arranging the lease are 20,000 pounds, and the trust has received a lease incentive of 5,000. The interest rate increased in the lease or no, but the trust has determined that its incremental borrowing rate is 5%. On 1 April, the lease liability is the net present value of the lease payment, not made on that date. This is the NPV of 450,000 calculated at 5% rather. So, like I told you, most of what you will need, they will give you. What they are really interested in is the liability part. So the asset part is also very important. So, but to build up that, it is NPV they need you to calculate. Then you now capture the interest payments as well. So when you add up the present value and the interest payments for the year one, for instance, then you now deduct the regular installments that you are paying. They will are giving you that amount too. So it will give you the balance that you open with for the second year. So let's go through this together. Total lease payment due are 10-year lease, so 10 times 50,000. But one payment is made on 1 April. This is the case where the payment is made in advance. Yes. So most type of lease is usually a payment made in arrears. So this will affect how we construct our we call it what type of table do we call it? I forgot it. So on 1 April, the right to use the asset is our asset too. The amount of the initial measurement of the liability. So when they multiply okay, let me try and do some maths. So we need to find the discount factor of 5. What's discount factor of 5%? That was what we will now use to multiply 450,000. Where they got 450,000 is I need to open your mic now so that, and I want to assume those that are disturbing us will cease from doing that. If you do that, I will close it again. No problem. So I need us to follow up together here now. Do you understand where they got 450 from? I've opened your mic. Talk.
Yes, sir. That is 50 pounds times 9 months. Since we are paying the first.
Why it's not month though? It's years.
No, they are paying 50. They are paying 50 pounds for 10 years or so. So and they are paying the first one on the first.
I'm not telling you it's years, not months. Not months. It's years. So
it's year. Oh, 10 years. 9 years. Okay.
So why are they paying? Why are they capturing 9 years, not 10 years?
Yeah, they said they are making one payment on the 1st of April, the first year.
God bless you. You really understand what we are. You really understand what we are doing. So they are making the payment.
But we can't see the questions. The screen.
Very well, Abby. Let me don't work. It's because I enlarge it. Let me reduce it a bit. Can we see it now?
Yes, sir.
Yes.
Okay. So I need us to in fact, that understanding is the most important thing there. So that whenever they want to even scatter it for you, you understand what you are doing. You separate each of them and you get what they are doing. Saying, I need somebody to find me the DF of 5%. Discount
For 1
factor
year
of
now.
5%. No, we will be taking it yearly now.
For what year?
I think
Zero
we have
0.9552 for year
0.9
one.
So yes.
oh yeah, multiply by 450. No, it will not be for any year, just like 1 year. Just do 1 year. Do 1 year. It will not be for, it will be constant per year, like for each year. Okay. Okay, wait.
It's like the annuity now.
Okay, do for 1 year. Let me see first. What is it for 1 year?
0.9523.
Multiply by 450. Let me see what happens.
42840.
Okay. So now do it for 9 years now.
Zero 0.645.
Multiply by 450. Oh, multiply by 450.
Two nine zero.
290,074.
290,250.
What did you get?
290,250.
You said
290,074. 290,074.
It's not aligning with what we have here.
290.25.
290.07.
Not aligning. Can we do an annuity of 5% for 9 years?
Annuity of 5% for 9 years is 7.11.
That would not also work. I'm coming.
7.108.
Hold on. Okay, so what I need us to arrive at can we find the NPV of 450 at 5% for 9 years?
What? So what exactly are we driving at?
Okay, we need to find what the NPV of 450,000 at 5% discount factor for 9 years that's the starting point of this analysis.
But what I think is that we first need to calculate the present value of the future instrumental payment on this lease, which is at the rate of 50,000 and 50 pounds for 9 years. The present value of that using the annuity of 5% will give us 355,391. I think that's the first thing they did there. And that gives us the total.
That's what we have been trying to do. If you can do the calculation, let us see now. Like explain.
Okay.
That's what we are trying to do. That's what we have been trying to do. But the figures we are getting is not agreeing with their own. But that is what they are expecting.
Okay, this lease is expected to run for 10 years. I haven't paid first year, so we're having 9 years left.
Yes.
So we have to be paying 1,000 per year after the first instrumental payment.
Yes.
Now, the 50,000 is a cash flow that is a similar cash flow, so we can only use annuity. So the 5% annuity, yes, the 5% annuity will give us 7.108 if we calculate it very well. The annuity for 9 years of 5% will give us 7.108. So when we multiply that by 50, then we'll be having 355,391.
You are correct. That was why I mentioned the last time that yes, let's consider annuity because I know it's an equal payment. It's not changing. It's a regular amount, and the period that it is being paid is also known. So let's come back to the class. Let me just quickly use Excel. But you need to give me the figure for the annuity. I think I even got it already. For some that will be having challenge on it. So we have our 5% annuity for 9 years. So we have the figure of 5% annuity for 9 years is 7.108, and the cash flow is 50,000. So let me quickly change the Are you seeing my Excel sheet now?
No, sir. No, we can't see it.
Okay, I'm coming. I'll need to change what I'm sharing. I hope you can see it now, Abi.
Yes, sir.
Yes, sir.
Okay, so this is what we are trying to do. This 7.108, there will surely be, but in the exam hall, you may not be given annuity formula. If you are doing SBR, it's only SFM that I'm very sure they will give you. But in SBR, I'm not sure they will compulsorily give you like that. But there is a formula for it. I don't remember the made-up of that formula. But if you calculate 5% annuity for 9 years, you will get this 7.108. Let me see if I can even see it.
The formula is 1 minus larger bracket open.
1 minus
larger bracket open. 1 plus R larger bracket close raised to power minus 9 all over the R.
You can't see this over here.
You can just
Hold
put
on.
the n there.
Raised power minus
Minus
n.
Okay, minus n.
Yes.
All over
All over
r.
R.
Yes.
Okay, this is what I will do. All of this will be in another larger bracket. Then over half. I think it's good like this. So let's apply it directly and see whether we get this 7.108. So we now have 1 minus into brackets 1 plus what's our half? 5%, Abby? 0.05.
Yes, sir.
Minus n. How many years are we considering?
9 years.
9 years.
I really need this for this time around. I practically need it here. It will not work if I just use minus n. It will not work.
Superscript.
Hey, I'm not able to press superscript. That's the point I'm making. Not this one. Hold on. This one is even telling me the formula is not complete. Voila.
Try
So,
shift 6. Maybe it will work.
okay, shift 6. It worked though. Okay, this per 9.
It is minus 9, though. If you place it at 9, you won't get it.
Okay.
Minus 9. Thank
Equal 0.05. Okay. Everything just maybe I don't need this as well. Well, okay, let me just do this one this way.
One more bracket.
Where? Here?
In front.
Hey, I put it before now.
This covers this. Okay. Are we present?
I present. It's telling me the.
You need to put some, I think. You need to put some, then bracket.
Okay.
Equal some, then bracket. Yeah.
Okay, you are right. So, everybody, can you see how we got this?
Yes, sir.
So that's where we got the 107, 108 form. But you may just need to practice the process so that what's likelihood for I can know, except if they want to bastard again, they will likely give you this the rates with which you multiply the cash flow. They will give you that figure. So you don't need to stress yourself about it, but it's very, very good that we go through it now and we are able to understand how we got that. So what we now do next is to just say it's equals to for my own distance, but what I'm trying to do here is to this is not what I want to do. So you multiply C3 by C4. So that's where we got the 355 400 form. Are we on the same page?
Yes, sir.
Okay, let me try and see if we can work each of the line one by ourselves.
Yeah, we can do that using normal TV.
Okay, I need to share this to the group so that you have access to this one. We want to the question I was the material I was using before is not part of the one I've shared. Some of you have seen it, have you? If you are in SBR1, you have seen it. Okay. So I will likely be using Excel going forward to practically do. I expect you to have the questions now. If it has not dropped, it will drop soon. So hold on. So let's start. Do you all have access to the question now?
Yes. Yes, sir.
Okay. So on 1 April, the right to use assets is what we just calculated now. Okay. Do you all agree to this? Hello?
Yes, sir.
So we agree that we are not using 10 years because it was mentioned that 50,000 has been paid at the beginning of the contract. So the remaining years are now 9. So that's why we use 9 years in our computation here. When you click on this, you see 9, where we have raised to power n and minus n rather. So that's why we use 9 there. So moving forward now. So according to the question says it was entered into 10-year lease on 1 April. This payment of 50,000 are payable each year at the start of the year. The direct costs incurred in arranging the lease are 20,000. So that direct cost is part of the so this amount that we have here is what we term the initial measurement of the liability. So initial measurement of the liability is what we have here. You know, it's the same amount we are capturing for the right of use assets. Yes. Where they differ is the fact that for the right of use assets, you will accumulate all other costs associated to it. So, meaning that this 355,400 is not the total right of use asset. Rather, as at 31st April, this is the amount of the measurement of the initial liability. So, the total liability rather on that asset, on that right of use assets. So let's take away this here. Rather, let me link it directly from what we calculated here. Yes.
Yes.
So the next one, we are measuring assets. So everything that are incidental to the costs of acquiring that asset will be considered. So for that reason, we also had plus any lease payments made on or before 1 April. So we will capture the payments we have made. How much was paid? Hello?
50,000.
50,000.
Okay. So also any direct cost incurred. Is there any direct cost?
Yes, 20,000.
Yes,
20,000.
20,000.
Good. So less any lease incentive. How much is incentive given?
5,000.
5,000.
So you can then sum it up. This is the right of use assets, but this is different from the liability. This is the right of use assets. It's different from the liability. The reason it is different is that what you are going to pay the owner of the asset is the liability. The amount you are measuring that particular property or assets or whatever with you is your right of use assets. Meaning that the amount you are carrying it in your book may be higher, far higher than the liability you are going to pay. Reason being that you have incurred extra expenses. This is different from what you'll be paying as per the amount charged as interest. So,
So please, can you come again? Because the right of use asset is less than the amount.
right of use
charged.
asset
I was
will be
thinking
greater. Most of the time, right of use asset will be greater than the liability.
So I was thinking you should, sorry, sir. Please, I was thinking you should link the 355,400 to that right of use asset and then do the remaining.
No, that's what I'm telling you now. The right of use asset is the 420,400. Do you understand what I'm saying?
Exactly, but because it's showing, yeah, exactly, but because it's showing under that liability side, that initial measurement of the liability.
No,
That's
yes,
why.
that's what I need you to understand. Where I wrote it, initial measurement of the liability is 355,400. Yes, it will be captured as, you know what actually led to the assets is the fact that we acquired that particular item from somebody and we are indebted to the person to pay over a period of time, isn't it? Hello?
Yes, sir.
Just like you want to acquire an asset, you want to buy an asset, you don't have money. You go and borrow money in order to acquire it. You know, having borrowed the money to acquire that asset is one thing. The amount you want to measure the asset is another thing. Why? It may be okay, the amount you borrow to buy that asset is 5 million, but you still have some other cash with you that you can spare, maybe 2 million, that you need to use to install that amount, that particular asset for it to become usable. Are you getting me?
Yeah, so sir, this can be like more of the associated cost, like other costs that is there.
Thank you. Thank you. So when it comes to the asset, it's more comprehensive, it's more broad than the liability. The liability is the obligation we are owing the third party, the lessor. Okay, the obligation we are owing the lessor, but the total amount we want to recognize as our right of use asset may be greater than that. It may be. It's not compulsory, but most of the time it's likely going to be, because there will be a particular cost incurred for you to transport it down to your home venue and even the commissioning and everything like that. So there is usually a difference between the two, and the asset will be, right of use asset will be greater. That liability is just one. Are we clear?
So basically, sir, please, the lease liability is the 355,400, while the right of the use asset is the 420,400.
Yes, you get it. Yes. So, if you want to build the table, this table they built here is not the one I can usually use to use. So I need to call your attention to it. This table is for right of use assets. The one I can usually test is liability. Whoever has come across their question can testify what I'm saying. There are two different things, and that is why I'm treating this question, so that you will not confuse yourself. In the one I can use to bring, you will surely see the liability. They will also indicate to you the interest payments. They will now tell you that they will have given you the amount that, I think I have a question too in the second material. I hope we have time to go through it too. So they will now tell you that they will have indicated in the question that this is the instrumental payment. That instrumental payment is the one you will deduct from the addition of the two, both in the interest and the liability, to give you the carrying amount of your liability as at the end of the year, which will open automatically for the next year. And you do it like that till you finish the payment based on the installment, because the installment already tells us how much you need to pay per each period. Basically, most of the time, each year, that will result in paying the whole amount you are owing at the end of those periods. So don't feel like this one is not clear. What is going on? Like something is wrong. No, nothing is wrong. Reason I'm saying this is that in this one, there is an inclusion of depreciation. In that one, there is usually not consideration for depreciation. In fact, what you only have is your lease liability. It will not even be this net book value of the asset, because you are not paying 420 400 to the owner of the assets. You're only paying 355 400 plus the interest elements. But that will be clarified based on how much is the interest to be charged. So I'm going to compute this table, but I don't know whether I should still go on with the table or we should I should cut off the depreciation part out of it. What do you suggest? Hello, is somebody there?
Yes, sir, we can hear you, sir.
Where are others now? Are we sure we are still together?
We are together, sir.
You're together.
Yes, we are together, sir.
You understand what we are doing? It's like this silence is killing me.
Yes,
we have
sir.
not even started, though. That's the truth. We have not started. But I need us to. So let me quickly build this table
Yes,
then.
right now.
Is that Dimo? What happened? Oh, yeah. Let's hear you. Oh, yeah, now. Oh, it's all right. So let's quickly build the table. I should be very fast about that. We have net book value of the assets. We also consider depreciation this time around. Lease liability. Interest charge. Cash payments.
Perfect.
So year one. I need 10 years, right? So what's the net book value as at year one? Is what we just calculated here. Do we have depreciation?
Yes, sir.
Depreciation of.
So how long is the asset going to last with us?
$10 years.
So this is my year one. I need to duplicate it the way. You know, there is one that's There's one that has to do with when what we calculated here. This is the amount that we have actually considered. So there is no depreciation as at that time. The lease liability we have is as calculated here. Interest is not charged. This is the beginning of the period. So let me tag this as April. So there's no interest. How much is paid out is this minus this. Okay? So that's what we have there. So as at the end of year one now, so we want to depreciate 42391 42391 for 10 years. How much are we going to be having per year?
$42.
42
naira.
42,040 naira.
Okay, so we have it there. I hope you can see my screen, yeah?
Yes, sir.
Yes, sir, you can see it.
Okay, so for that end of year one again, okay, let me do something.
Style down. Where not?
Okay, so when I take away the depreciation from the net book value, it gives me the current net book value as at the end of the year here. Do you understand that?
No, sir.
Yes, sir.
Not really.
That's okay. Out of the initial amount that we calculated as the value of the right to use assets, 420,400. We charge depreciation of 42,040. That resulted in we are deducting that that depreciation from the initial figure that we have. Okay, so the next one is to consider what is our interest charge? What's our interest charge? You will take the lease liability multiplied by the 5% that we use as the implicit rate we use to derive our
Interest charge.
yes. So that's where we got this 17,770 from. Then you had it back to know the total lease liability you are still owing, because that's the total amount you are still going to pay.
Sorry, sir, can you come again? That's 17,770.
It's normal to cut out. I understand. I can read it. Yes. What I did is that, firstly, this 42 is just, we are trying to consider depreciation straight line method for 10 years of this 420, 400. Do you get that one?
Yes, sir.
Yes, sir.
Okay, so having done that, then the balance that we have as at the end of year one is now going to be the 420 that we have at the beginning minus the depreciation charge. Is that clear?
Yes, sir.
Okay, so I now said, okay, to get the lease liability, you need to first consider what is the interest charge. So the interest charge is the value of the lease liability at the beginning of the year multiplied by 5%. That 5% is the rate they gave us to use for calculating the NPV that we did earlier. Is that right?
Yes, sir.
Hello?
Yes, sir.
Do you understand? Who is the person asking me? I'm not able to see your face now.
Yes, sir.
I'm on the Excel. Okay. So, having done that, then to get this one now, then you need to do addition of what your interest charge is away from what you need to take it together to get what the value is as at this time. Is that okay? Is that okay? Nobody's asking again.
No, sir. No, sir.
Ah, it's okay by
Yes,
me.
sir.
Which one should we say? Is it no or yes?
I can come again for clarity.
Okay, the last thing I said was that for the interest charge, it is 5% on the lease liability. Can you see my cursor?
Yes, sir.
That is clear, Abi?
Yes.
Yes, sir.
Okay. And for the amount we now have here, is we are trying to consider what the lease liability is initially and the interest charge we are meant to pay. So that's first year goes that way. We are still within the ambit of the first year. I just like making provision for that. So for the depreciation itself, but others are still within the ambit of what has been paid and what are we looking up to be paying. So for the second year now, let's do 378 minus this minus this. I'm coming. Okay. Just trying to confirm. So for the second year, the net book value is going to be, you deduct your depreciation from it. so that when you add the two, it's going to give you what we have at the closing of last year for last year. So just deduct the depreciation as we did the other time. Okay, so we take away 42,040 from 378, 370, and 360 to get 336, 320. Do you understand?
Yes, sir.
I mentioned earlier, I'm going to release this to you. You can always go through it and get back to me. This particular standard is complex. It's usually confusing, yes, but just try and pay attention. That's why I'm taking my time to go through it this way. I will try and share the. Okay, I shared the other material with you already, so I'm not sure we have the time we tweet that too, but that one is also is simpler, seriously, because they did not take all the years like this and they don't even do elaborate calculation like this. But notwithstanding, if you understand this one, the one they will give you in the exam is usually likely going to be smaller and simpler than this. If you understand how we are doing this one, you will find it easier. Those reading. So can you help me with the 5% of these three? Okay. This is not correct. Let me do something.
Can anybody hear the tutor?
Network has taken him away.
Can anyone see hearing, please?
No,
I
the
can't
network.
even hear you. The network is treating him bad.
It's not likely to return.
At least everyone has learned something today.
Yeah, so we've learned a lot today.
I think we needed to do the payment schedule amortization table separately before we come to this stage is.
Yeah, so that's true. But I was thinking that probably why he didn't want to do that is,
It will be
so that
confusing.
we
It will be
can be
confusing.
it can be showing us the steps exactly.
It will be confusing if it does it this way.
Check and make we dey go.
No, they come back again. No, they come back. No, they come back.
They will definitely come back or will write us on the group. Let's just wait a bit.
Okay, so I want to ask, since this they've made initial payments, like they made payments in advance, that the 50,000. So when during working on this amortization table, are we going to start from year 2? Because I tried doing from year 1, I still have like 1 year left. But if I start from year 2, if I start amortizing from year 2, everything balances. I ended up having a zero balance. I just want to understand, since we've already made a payment in advance, the payment you're supposed to make in year 1, we made it in advance before the end of the period, before the end of year 1. So are we to start from year 2 or year 1? I don't know if anybody understood what I'm asking.
We start from year 2.
Yeah, you start from year 2 because
Okay.
already you've paid for the first
Because
one, so
you
you can't
paid for the
amortize what
first
you have
month,
paid for already.
for the first year.
Okay.
Yeah.
Okay. Thank you.
Adjustment to revenue. Measurement of the
Please, can you mute yourself?
He said he has been trying to connect, but he's not connecting. So at times, all this modem, they are better than all this network. You just get a modem. Like modems, all this Wi-Fi, it's better than the network. The internet is well.
Our organ never come back. Yeah.
use transfer ownership of the underlying asset.
He's trying to come back. The network is the network. He said he's trying to connect. That it's not connecting. So let me ask him if we can call it a day. Everybody people know that class have ended. Okay, he said he's not be able to connect. So he's going to do the exact computation and share it with us later tomorrow. So we can call it a day that he's been trying to connect, he couldn't get back.
Thank you very
All
much for
right.
this.
Thank you, lady.
Thank you.
Good night,
Good
everyone.
night.
All right. Thank you.
Thank you.
Thank you, class rep. Thanks for your effort.
Hello, everyone. Please, what was the information the class rep passed, please? I missed out that, please.
The class rep said that the lecturer cannot be able to reconnect. So for that reason, he's going to compute. Okay, we are closing the class. He's going to recompute it and send it to us tomorrow.
Okay, all right. Thank you very much.
Hello, please. Is this class still on?
I think you can opt out because it's almost time.
Okay. Thank you very much. But please, I want to ask, when he left the I think it was network, when he left, did he still come back? Or that was where he ended the class?
Please, has the class ended?